Okay, welcome. We continue with our lecture number 4, which is on investment analysis. Now, investment analysis is divided into fundamental analysis and technical analysis. Now, we start with fundamental analysis. Now, the fundamental analysis says this rely upon the examination of fundamental factors which affect a business. So this involves analysis of individual business, industry, and the economy as a whole before you select or you choose the share to be included in your portfolio. Now, in fundamental analysis, it involves detailed analysis of fundamental factors which affect performance of economy, performance of firm, and the performance of the industry in which that firm belongs. Now, when the investor conducts fundamental analysis, the investor will compare the intrinsic value of share with the prevailing market price to arrive to the investment decision. Now, the intrinsic value, this is the economic value of firm or share, which is arised by using different or various fundamental analysis technique. Now, after obtaining the intrinsic value, compare the intrinsic value with the market price. Now, say if the market price of share is lower than the intrinsic value, we say the investor would decide to buy the share as it is underpriced, and vice versa. Now, steps involved in fundamental analysis. We normally start with economic analysis, industry or sector analysis, and last we go for individual company analysis. Now let us start with economic analysis or economy analysis. Now say the performance of company depends upon the performance of the economy. Now we have factors such as the growth rate of national income, the economic cycle, whether it is boom, recession, recovery, or deflation, or with other microeconomic factors such as inflation, exchange rates, infrastructure, interest rate, economic and political stability, government revenue, expenditure, and deficit. All these affect the firm performance or will affect the performance of the firm, which at the end will affect the performance of the share of that particular company. So before one decide the share of the company to invest, must undertake the economic analysis so that can know the performance of the economy, because the performance of the economy have an impact on the performance of individual firm. Now, after I complete the economic analysis or economy analysis, next is to analyze the industry or sector in which that particular firm belongs. Now, say the performance of the companies is influenced by properties of the industry in which that particular firm belongs. Now, industry or sector says this is a group of firms producing reasonably similar product which serve the same needs of common set of buyer. So industry, this is a group of firms which are producing similar product or rendering similar service, so they involve the same production process. Now you need to look, when you're analyzing the industry, you need to look at the industry life cycle. Now say analyze things like industry life cycle, industry characteristics, demand and supply gap, competitive condition in the industry, labor condition, attitude of government toward that particular industry, supply of raw material. If you analyze all these factors, will give an indication that that industry is performing well, or it is declining, or it is growing, or it is a stagnant industry. So before you decide to invest in a particular firm, you need to analyze the performance of that particular industry. Now, after analyzing the industry, next is to analyze the individual company. So you want to invest in company X, you need to analyze that particular company to see the performance of that company in comparison, or by comparing with other companies, or compare with the industry average. Now the next step of our analysis will be the company analysis. Now says this is the final stage of fundamental analysis. So you need to look at the level, trend, and stability of earnings of the company. However, this depends on number of factors concerning the operation of the company. So you need to analyze the performance of the company by looking at the trend over a number of years to see whether this trend is good or it is fluctuating or it is stable or whatever. Now, normally when you're analyzing the performance of the company or the performance, the individual company, we normally undertake what we call the financial statement analysis. So this part will give out the financial performance of the company. So we can look at the financial performance of the company through financial statement analysis. So when you're analyzing the financial or in order to calculate the financial ratios which are used to know the progress of the company, normally many of the information will be obtained from financial statement. Now, the financial statement of the company help to assess the profitability and the financial health of the company. Now, analysis of financial statement can be achieved using various ratios. We have liquidity ratios, which show the ability of firm to meet short-term maturing obligation. We shall look at the leverage ratios or gearing ratio. We shall look at the ratio of the company's asset financed from debt. Profitability ratio, percentage of profit on sales or on the asset of the company. And also we shall can look on activity or efficiency ratio, ability of the company to use its assets in generating revenue. Now, these ratio will assist to get those information and know whether the performance is not good or it is good before we decide to invest in that particular company. Now we have other variables which will be taken into account which relate to individual company before we decide to invest in that particular company. We have things like company market share. So you need to analyze and see the percentage of market share of the company in that particular sector or industry. And also need to know the capacity utilization, how the company is utilizing its capacity in order to generate revenue and profit. And also need to see the modernization and the expansion plan of the company. Now you need to know the plan for future acquisition of modern equipment, research and development, which, if are successful, will enable the company to generate huge profit in the future. Without modernizing or expanding or undertaking research, the company may be defeated from the market in the future. So before you decide to invest in that particular company, you need to look at other variables apart from the financial statement analysis. So you need to look at the company's market shares, company capacity utilization of the company, modernization plans, and so forth. Now after analyzing and knowing the performance of the firm where the company wants to invest, so the company can analyze different companies in different industries. So they can have a number of companies where the company can invest. Now, after the fundamental analysis, next, let us look on the stock picking. Now, stock picking says this means making choice as to which share to buy. So you choose which share you want to buy or you want to invest after analyzing, after looking on the fundamental factors of the companies where you want to invest. Now we say different individuals or different investors will follow different strategies when they want to invest in a particular share or in a certain shares. Now say there is no one correct approach or there is no one correct strategy which can be followed by all investors. Everyone will follow or will use different approach. It's a matter of justifying the method you are applying. Now let us look on different stock picking strategies. We have about 6 stock picking strategies. The first one we have called the income investing. The other one is the value investing. 3, it is known as contrarian or overreaction investing. The other one is known as the growth investing. And the last one we call the growth at reasonable price investing. And we have the other one which is known as the technical analysis. Now let us see these different strategies which are followed by investors to choose or to select stock to be included in a portfolio. Now the first approach or first strategy is known as the value investing. Now say investor who follows this strategy, they are known as value investors. Now the value investor look for the stock with strong fundamentals. So normally the value investors look for stocks or shares with strong fundamentals like earnings, dividend, book value, and the cash flow that are selling at a bargain price given their quality. So they are looking share which is undervalued. So the value investor normally they are looking for share with strong fundamental factors such as stable earnings or high earnings, dividend and book value, and cash flow, but they are selling at a low price. So say if that is the case, that company or that shares will be undervalued. So they want to buy at a low price, expecting after some time the share value will increase and they'll be in a position to make profit. So say the value investors seek for companies that seem to be incorrectly valued or undervalued by the market and therefore have the potential to increase in share price when the market corrects its error. Now say guide for picking value stock. The company should have more equity than debt. Current assets should be at least 2 times current liabilities. The average earning growth should be at least 7% per annum, and it is calculated over last 10 years. So these are guides which you need to follow when you want to choose the value share, or these are strategies or guides which are followed by value investor who follow the value strategy. Now the next investment strategy or stock picking strategies, it is known as the growth investing. Now say typically growth investor look for investment in a rapidly expanding industry, especially those related with new technology. So the growth investor normally want to invest on the company which are fast growing. So normally growth investor is interested in capital gain. So they buy now expecting that in the future the company will be growing. So in the future the price of the company's shares will increase. They'll be in a position to make a profit resulting from capital gain. So they buy now when price is low, expecting that in the future the price will increase and they'll be in a position to sell and make a profit resulting from capital gain. Now, according to growth investing strategy, we say the growth investor are concerned with companies' future growth potential. So they are looking at the potential for future growth. So say those who follow these strategies are known as growth investors. So the strategy is known as the growth investing. And those who apply these strategies are known as growth investor. Now say the growth investor focus on the future potential of company, which must less emphasis on the present price. So they are not looking at the current price at which shares of the company are sold, but they are interested with future growth. Now say the growth stock or company with growth substantial faster than other. So the growth investors are therefore plainly concerned with young companies. So the theory is that growth in earnings or revenue will be direct translated into increase in price. So the growth investor is looking for a young company in a fast-growing sector, expecting in the future the company will grow and the price of shares of that company will be much higher. So the growth investors, they are not interested with the current dividend, but they are interested with future capital gain. Now after growth investing, let us look on the other strategy which is known as the contrarian investing. Now say an investor who follows this strategy is called the contrarian investor. Now say the contrarian investor normally take the opposite position in the market. So they say they invest in stock that are declining in value. The investor is betting on the market changing its mind and the price rising. So the contrarian investor normally take an opposite position in the market. Well, others are selling, then the contrarian investor will be buying. So they are betting that market will change its mind, its position or its mind after some time, and the price will start rising. So say contrarian strategy tend to work within a very short period or within a very long period. So for a short period is 1 week or month, and for a very long period is 3 to 5 years. So the contrarian normally they move in the opposite direction. Now the contrarian investors take an advantage of overreaction of investors. Now overreaction says this is a tendency of investors and traders to overreact to companies announced or new released information. So says this action suddenly inflate or deflate the stock value, but only temporarily until the impact of announcement diminished. So contrary, they believe that if there is a new released information, current investor will overreact. So that overreaction will result into either inflation or deflation of share price. So they buy expecting that after after the impact of the information diminish, the price will go back to the correct price. So they'll be in a position to make a profit on that. Now we have a graph which shows the impact of new information. So we have a vertical axis, which is the stock price, and we have the horizontal time. So if there is a new information by the company or relating to the company, they believe that the investors will overreact. So as a result of overreaction, if that information, the price was at this level, and due to new information, the price is supposed to be at this level. Now due to overreaction, the price will go below up to this level, up to this point number 3. So if the impact of the information diminish, then the price or the market will correct the price or will correct its error up to this level. So contrarian, they normally buy at this lower level. So they buy at a low price because price go down because of overreaction. And when the market corrects its error, due to if the impact of new released information diminish, then the price will go to the correct level. So they'll be in a position to make a profit by selling at this higher price. So this is how the contrarian work or contrarian investor work due to over reaction of investors. Now we have another investment strategy known as the gross at reasonable price investing. Now says this is a strategy which combines both value and gross investing. So it looks for a company that are somewhat undervalued and have solid sustainable growth in the future. So these are combining features of both value and the growth. Now it says growth at reasonable price investor look for a company fall right between those sort of value and growth investors. So they are looking for hybrid characteristics like growth investors. So say the growth at reasonable price investor are concerned with the growth prospect of the company. They like to see positive earnings for a number of past few years, coupled with positive earning projection for upcoming year. Now after we've looked on growth at reasonable price investors, now we have another strategy which is known as the income investing. Now income investing is the strategy which is followed by income investor. Now according to this strategy, we say this aim to pick companies that provide a stable stream of income over years. So say income investor are interested with fixed income securities such as bond and so forth. So say income investors usually end up focusing on older, most established firms which have reached a certain size and are no longer able to sustain a high level of growth. So income investors, they are looking for stable income or stable earnings throughout the investment period. So normally they will choose to invest on bonds where they'll be receiving a fixed interest, or put their money on a fixed deposit accounts with the bank. So there will be have assurance of receiving a certain amount of fund. Or if they invest on shares of the company, they will choose the company which is matured. So as we know, the matured company or more established company, they will be paying dividend regularly, because in the area there is no much growth potential. So larger portion of profit will be distributed to owners in a form of dividend. Now, say income investors, these are companies generally no longer in rapidly expanding industry. And so instead of reinvesting their earnings into themselves, matured companies tend to pay retained earnings as a dividend, as a way to provide return to shareholders. So, say dividends are more prominent in old and matured firms. So income investors will be interested in this, in following this strategy.